Hello and welcome to my morning note. It looks as though stock markets are doing very well at the moment, particularly if you take a look at the US, where indexes are near all-time highs. But I'd like to argue that in fact the US is at the moment functioning like one giant haven, an oasis where you can actually find some yield in an otherwise yield-starved world. Take that into account and world markets really begin to look very pessimistic indeed. That's the way I look at it anyway. With me now to discuss this is our global market commentator, Jamie Chisholm. Jamie,
hello.
Thanks for coming on board. Let's start by taking a look at these indicators, all of which seem to suggest we're distinctly into a risk-off moment, and yet stocks continue to do very well. What on earth is going on in
Well,
your opinion?
you're quite right, and the piece of particular interest, of course, is here, the last couple of months when stocks have risen primarily to the records that you mentioned.
Yes.
It's possible, of course, that with the bond yield going down, that could be a good thing for stocks. People could see it as the
Yes.
QE being extended. This spike here was when they thought the Fed was going to pare back the QE, but no. And
Makes them all the more yield hungry.
Exactly, more yield hungry. We've also got the Bank of Japan, as we know. People think there's going to be income tourism from Japanese investors to the yield. However, the problem is that
QE, yes, QE
look
should
at the
be helping.
cyclicals.
Yes,
exactly. Look at the cyclicals and look at the metals. Now, everyone talks about Dr. Copper having a PhD of the economy. It's probably not that great now. It might be looking more at fundamentals. But even so, it's very hard to argue that things are looking so good when the industrial metals are moving down like that. They should be a decent barometer of expected growth, and that's not really very positive. So that is saying risk off.
Precisely. Now, let's take a look at world stock market performance in some context. This is from the nadir back in March 2009. You can see that the world outside the USA has tailed off almost completely in the last few months, and also that it's dividend yield that has really excited people, that has really generated returns rather than necessarily the mainstream US market. What do you think is going on there? Why the hunt for yield?
Well, the hunt for yield goes back to the previous chart, of course, when we saw the treasuries were so low. They're 30 basis points below the point when they spiked higher after the Fed comments in the Fed minutes from January.
Yeah.
They're now about 1.7%, a little bit lower as we speak now. And yet, according to research recently done by Stratigas, there's 25% of the S&P 500 have a higher yield than the long bond, the 30-year bond.
Which is extraordinary.
Exactly, which is quite extraordinary. So obviously people think that's where I can get yield. US stocks will go in there. The other point, of course, is that if they're domestic US-based stocks, the US economy has been doing a little bit better than a lot of other economies, especially in Europe, for example. So people see that as the haven to go in and get the higher yield, and they're not exposed so much to problems in Europe.
But now, how do we move on from there? The last day we've had lousy economic numbers out of Europe and fantastic stock market performance out of Europe. What is going on there?
We're quite right. Again, as we speak today, the top-down look at the markets, the macroeconomic look at the markets, is barely featuring at all. The European stock market was up more than 2% on Tuesday, and we've had a swathe of pretty much, apart from some US housing data, rotten numbers on the manufacturing front. The only thing I can assume is that there have been some slightly better earnings. The main thing is that we're still getting this idea about liquidity. Bad news is good news.
So they think there's going to be a rate cut from the ECB, even though the ECB have been so hawkish?
There's a couple of things on the European front. They think there could be a rate cut from the ECB, although the euro is only down about 30 or 40 pips at the moment on the day.
Right.
But the other point is I think they quite like the idea that there's more talk now in Europe about reining back on austerity, which could ultimately perhaps help that economy, although it's very rare that the stock market looks that far forward about things, I have to say.
Okay, Jamie, thank you very much indeed. If you want some broad conclusions to draw from all of this, it's that first of all, the markets are worried by the shape of the global economy. They don't like the way things are going. There is great excitement and hope that there will be more easy money from central banks, and maybe there is also some hope that governments are going to loosen back on austerity.